This is Nightly Business Report with Bill Griffith and Sue Herrera.
Fed speak. The central bank chair calls inflation pressures transitory, and investors wonder if an interest rate cut is now off the table.
Sell in May and go away. It's an old adage on Wall Street, but are you better off ignoring it this year?
Textbook merger. A merger creates a powerhouse in the world of higher education, just as the entire industry undergoes massive shifts. Those stories and more tonight on Nightly Business Report for this Wednesday, May 1st.
And we do bid you a good evening, everybody, and welcome. It was a relatively quiet day on Wall Street today until Fed Reserve Chair Jerome Powell dashed any hopes of an interest rate cut. At least that's how the market seems to have interpreted his comments on inflation during his news conference today. During their two-day meeting, central bank policymakers decided to keep rates unchanged. That was not a surprise, but speculation about the future sent Treasury yields higher and stocks lower. The Dow Industrials fell 162 points, about the low of the session, to 26,430. The Nasdaq was down 45, and the S&P was down 22. In Washington, Steve Leisman has more on what the Fed said.
Fed Chairman Jerome Powell tamped down market expectations for a rate cut at his press conference Wednesday, saying the drop in core inflation, which excludes food and energy, was less of a concern than many believed because it's likely to be transitory.
That the committee would be concerned if inflation were running persistently above or below 2%. We do see good reasons to think that some or all of the unexpected decrease may wind up being transient. If we did see a persistent inflation running persistently below, then that is something the committee would be concerned about and something that we would take into account in setting policy.
Powell pointed specifically to recent sharp falls in prices for financial services and for apparel that he believes will work their way out of the data in coming months, causing inflation to firm. Core inflation has fallen, however, for 3 straight months, even amid strong growth, and stands at 1.6% year over year, moving further away from the Fed's 2% target. Markets had come to believe that declining inflation could be a reason for the Fed to cut rates in coming months. But the immediate market reaction to Powell's comments was lower stock prices and higher bond yields as markets thought twice about whether that rate cut was really coming. The Fed in its policy statement made generally positive comments on the economy and the outlook, noting that the labor market remains strong and that economic activity is rising at a solid rate. And Powell in his press conference said some of the risks that have kept the Fed on hold have eased.
It appears that risks have moderated somewhat. Global financial conditions have eased. Recent data from China and Europe show some improvement. And the prospect of a disorderly Brexit has been pushed off for now. Further, there are reports of progress in the trade talks between the United States and China. The committee views these developments, along with the outlook for continued growth, a strong job market, and muted inflation pressures, as consistent with continued patience.
But Powell also made clear that while a cut may not be in the cards, neither is a hike. In the Fed's new policy of patience, the market will have to wait until the data more clearly signals the right path for rates. For Nightly Business Report, I'm Steve Leisman in Washington.
It is the 1st of May, and investors often start this month by asking whether they should take an old adage to heart and sell in May and go away. Bob Pisani went in search of some answers.
Sell in May and go away. You know, it's that time of year again, but this year you may not want to sell and get out, maybe not just yet. The best 6-month strategy has become legendary on Wall Street. Sell in May and go away means investing in the Dow Jones Industrial Average between November 1st and April 30th, then cashing out, switching into fixed income for the next 6 months. That has dramatically outperformed just owning the Dow from May 1st to October 31st. So here's an example. If you invested $10,000 in the Dow in 1950 from May 1st to October 31st, you'd end up with a little over $11,000 today. That's a measly gain of a little over $1,000 in 69 years. But if you invested the same $10,000 from November 1st to April 30th, you would have a return of over $1 million. That's according to the Stock Traders Almanac. That's huge. And by the way, that's the power of compounding interest. So why does the Dow do better between November and May than between May and November? Well, first, there are some clear seasonal trends in market trading. There's slower trading activity in the summer, back to school, end of the third quarter portfolio window dressing that's caused stocks to sell off in September and sometimes October, which is why September and sometimes October typically bad months for the year. But when you move into November, companies' efforts in the fourth quarter to beef up their numbers can help drive the market higher, as do holiday shopping and an influx of year-end bonus money. The bottom line is this: sell in May does not necessarily mean May will be down, or even that the next 6-month periods will be down. Doesn't mean that. The point is that most of the market's gains occur November through April, and that the market tends to drift sideways and is more prone to sell-offs in the May through October period. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Let's turn to Mike Bailey now for more on sell in May and go away. He's Director of Research at FBB Capital Partners. Mike, thanks for joining us tonight.
Great to be back.
You don't think it's a good idea this year. Why?
We don't for a couple reasons. One is if you take a look at what's happened the past 6 months, it's basically been an okay period. So the Dow's up about 6%. That's not that great. If we were to look back and if the Dow was up 15, 20%, you might say, okay, now's a good chance to take a breather. But we really think, the next 6 months, you could see the same type of upside. So we do want to be invested. The second piece is sort of looking at the alternatives. So fixed income, if you were to sell all your stocks now and go to fixed income, you're really not looking at a whole lot of returns. So I think for us, we'd rather stick with equities for the next 6 months.
You also make the point that you don't just have to get it right once. In other words, when you decide to get out and shift into another asset class. But you also have to get it right the second time when you decide to go back into stocks.
That's right. So it's two different decisions. You have to, be smart on selling now, and you really have to be smart about getting back in November. So it can be pretty difficult. We can get into some of the behavioral pieces too. I mean, a lot of people can get concerned about procrastinating, buying back, or anchoring to the sale price now. So a lot of concerns there. In fact, another way of thinking of it could be twisting it around if you're a buy and hold investor, and perhaps you want to always remember to buy in November. It sounds a little silly, but that's another way to think about it. If you've got some cash, you've been saving up, put it to work in November, and then kind of do the same thing every year. It's a little bit easier. You only make one decision instead of two.
But you're staying with the market right now. Which sectors do you think are going to do best over the next 6 months or so?
Sure. So, in general, we're sort of diversified across the board. We do think tech continues to rally. There's a lot of nice growth, sort of companies that are growing over a number of years. We see that continuing. We see healthcare looking a little bit more interesting. Some of the healthcare names have been beaten up. We like some of the pharmaceutical names and some of the life sciences names. So there's a lot of different interesting companies out there. We're not major over or underweight any particular sectors, but healthcare and tech look pretty interesting at this point.
If you wanted to go into fixed income, what part of the yield curve would you favor?
We still like the front end. At this point, you're really just not getting paid a whole lot to go out the curve. If you want to lock up your money for 5 to 10 years, that's fine, but you're really not getting a whole lot of return. So at this point, we're really just rolling over very short term, 6 month, 1 year, possibly 2 year bonds, a little bit more than that. But I think at this point, that's probably the best way to go. At some point, you get a better yield curve and you can go out a few more years.
Very good. Mike Bailey with FBB Capital Partners. Again, thanks for joining us tonight, Mike.
Great. Thank you.
Private sector job growth grew more than expected last month. According to ADP's payroll report, employers hired 275,000 people in April. That topped the estimates, which were 180,000. The increases were concentrated in the services sector. The report is often considered an early read on the more closely followed non-farm payroll report, which will be issued by the Labor Department this Friday.
Meantime, manufacturing activity hit a 2-year low last month as orders for new goods declined. The Institute for Supply Management blamed trade issues and global growth headwinds for that slowdown. And separately, construction spending unexpectedly fell 0.9% in March after 3 straight months of gains. That decline was due to both a drop in private and public construction projects.
Some of the world's major automakers reported their U.S. sales figures for April. Nissan and Subaru posted increases, while Fiat, Chrysler, and Toyota saw sales fall last month. The mixed picture comes as the average price of a new car, according to Edmunds, is expected to climb to more than $36,700, the highest level seen so far in 2019.
Time to take a look now at some of today's upgrades and downgrades. McDonald's was downgraded today to neutral from buy at Longbow Research. That call was based mainly on the stock's valuation. It's near an all-time high, and the analysts noted that the company's solid comp store sales growth. The stock was down more than 1.5% in today's trade to $194.17. Corning was upgraded to buy from neutral at Bank of America Merrill Lynch. The analysts cited the potential for growth given the company's near-term investments. Price target, $40. That stock closed at $32.31, up about 1%. And Take-Two was upgraded to outperform from market perform at Cowen. The analyst calls Take-Two the most attractive opportunity right now in the video game sector. Price target, $113. That stock rose 2% today to $99.05.
Coming up, high school seniors are saying yes to colleges, and parents are saying yes to taking on more debt. Some things to think about before signing on that dotted line. CVS issues a healthy outlook, and that's where we begin tonight's market focus. The company easily surpassed earnings and revenue estimates thanks to growth in its Aetna health insurance business. CVS said its pharmacies filled more expensive drugs, and its new health hub centers in Houston attracted more customers than expected. The stock was up nearly 5.5% to $57.33. Humana also topped revenue and earnings expectations, thanks in part to higher premiums. But the company warned that its 2020 earnings could take a $1 billion hit from an industry-wide fee and a proposal to overhaul rebates. The CEO also said he would not back any legislation that would make private health coverage illegal. That's referring to the Medicare for All proposals being discussed on Capitol Hill. Shares fell more than 3.5% to $246.16. Sales in Asia helped Estée Lauder lift its full-year guidance for the second time this year. The cosmetics maker reported better than expected earnings and revenue on strong demand for its luxury skincare brands. But the stock was down just a fraction to $170.30.
Shares of cruise line Royal Caribbean is making waves after posting strong quarterly results. That company reported an increase in both passenger ticket sales and onboard revenue. Following those results, the stock soared by nearly 7% to $129.03. Online ticketing company Eventbrite fell sharply in after-hours trading tonight after reporting a wider than expected loss. It also warned that second quarter results could come in below current analyst expectations, and that sent the stock sharply lower in extended hours tonight. It closed the regular session at 24.15. Also after the bell tonight, Qualcomm reported better than expected earnings and revenue, but the CEO told CNBC that weakness in China affected their guidance. The company also disclosed it's going to receive about $4.5 billion from Apple as part of the recent legal settlement between those two companies. The stock was volatile in initial after-hours trading tonight.
Some are calling it a win for Wynn. Massachusetts regulators will allow the casino company to keep its gaming license in that state, but it will have to pay a multi-million-dollar fine in the wake of a Me Too scandal that embroiled the company in a year-long investigation and endangered big casino plans for Boston. Contessa Brewer has the details.
The decision to allow Wynn Resorts to keep its Massachusetts license clears the path for the opening of Encore Boston Harbor. The integrated casino resort is scheduled to open in June in Everett. It wasn't a sure bet. In the 15 months since the Wall Street Journal first published a list of allegations against the founder of Wynn Resorts, its chairman and CEO Steve Wynn, the company was scrutinized by investigators from Nevada and Massachusetts.
You were making excuses for high-level folks that had failed to do their job.
Those investigations concluded company executives repeatedly, over years, failed to protect employees and failed to apply their own policies to Steve Wynn after serious accusations of rape, harassment, and other sexual misconduct, charges he's denied. And the company, its board and executives, never informed gaming regulators when they learned of the allegations and settlements. The company was assessed a $20 million fine in Nevada and a $35 million fine in Massachusetts. But the Massachusetts Gaming Commission determined there is no substantial evidence that Wynn Resorts willfully provided false or misleading information to the commission. Executives and directors were also found suitable to hold the gaming license, including the only two remaining individuals from the original license application in 2013. Elaine Wynn, the company's largest shareholder and co-founder and ex-wife of Steve, and CEO Matt Maddox. But the commission fined Maddox $500,000 for his own failures to investigate allegations properly and ordered him to have executive coaching for leadership, an embarrassing reprimand for the CEO of a global company. But Maddox was also given credit for significant changes made by Wynn Resorts in the scandal's wake. New board members, new policies, and a new culture.
This company is never going to be about a person again.
Gaming analysts are generally upbeat about the decision. They call it an optimal outcome and say it allows Wynn to focus on the future on a global scale. That's especially important as Wynn Resorts competes to land a gaming license in Japan. But for now, the focus will be on launching its gleaming new property on the shores of Boston Harbor. Contessa Brewer, Nightly Business Report.
In other news, two textbook giants announced this morning that they plan to merge. Now, if this deal is approved by regulators, the combination of McGraw-Hill Education and Cengage Learning Holdings would produce the second biggest publisher of college textbooks and higher education materials in the United States, with annual revenue of more than $3 billion. We have the two CEOs of both companies with us tonight. Nana Banjari is the CEO of McGraw-Hill, and Michael Hansen of Cengage, who will become the CEO of the combined company that will be called McGraw-Hill. Welcome to both of you. Thanks for joining us tonight.
For having us.
So why merge now? And I'm curious, who called who?
Right. I can start, and if that's acceptable.
Okay.
You know, I had a chance to meet with Michael, I would say in July or August last year at a conference. We were introduced by a mutual friend. And the conversation quickly led to a situation where we understood that we were looking at a common vision of what we understood of our industry, what plagues our industry as the challenges, and also a vision of what would be an exciting future for us to gravitate to. That led to more conversations and making a recommendation to our financial sponsors.
And I guess what you feel with doing it together, you can do it more cheaply then. Is that the idea?
For sure, there's a basis for kind of, if you have a common core and a common backbone, you can then allow yourself to reinvest in a business that really has been deprived of growth. So the point is, you have to find yourself an opportunity to invest in growth.
The idea, I guess, is to bring the cost of textbooks down. I mean, that's a big cost for college students. How are you going to do that?
Absolutely. And, you know, this doesn't start with the merger. We have started to do this way before the merger. And, you know, education costs are a real barrier for students today, and textbooks are part of that. Right. So we started to introduce at Cengage a model which is a subscription model that for one fixed price, instead of buying multiple textbooks, you get access to all the textbooks. And you get it online, and you get it in a very affordable way. How much is that? That's $120 a semester, and that compares, or $180 a year. Mm-hmm. That compares to the average student spending around $500 today. So it's a significant saving for the students. So affordability is absolutely key to what we do. And in the combination between the two companies, we can continue to do this and drive even more value. Is anybody else doing this model? I mean, Pearson is the #1 textbook publisher. You guys will be #2 combined. But is anybody else using this subscription model right now? You know, there are different varieties of it. So the McGraw-Hill is kind of the status quo, and something we plan to preserve because the optionality and choice is very important to us. The inclusive access model, which is different from what Michael described, is making the course, especially the digital platform course, available to students on the first day of class, making it easier for them to buy at the point of registration at 50 to 80% lower cost than they would have bought if they were buying from the bookstore. College costs too much. We know that. Yes. How are we going to bring the cost down? There's no real competition as we know it. You know, students don't shop for college the way they would shop for clothing. Colleges don't price the way a clothing manufacturer would price to try and lure somebody in. So how do we bring those costs down, do you think? Well, I think, Bill, you're hitting on the key point, which is transparency and competition, right? And we have experienced this in the college textbook market. We have a lot of competition out there. There are rental companies. Amazon is in this market, renting textbooks. There are companies that sell used textbooks, etc. So we have seen the competition, and the competition has frankly led us to sharpen our pencils, to really focus on the student experience, and on affordability. And I think broader, to your point, broader, every player in the system, whether it's a college, an online college, or any supplier in this system, needs to be held accountable to the value that they're really adding. And we are all for it, but we're also starting at home. as opposed to pointing to other people that should be doing a better job.
What do you think? Does it take a drop off in enrollment to bring costs down eventually or not?
No, we hope not. I mean, education has a very important societal role, and I do agree with the point that you made that it has become very expensive. We, as publishers of content, whether it's digital or print, have a role to play. We're completely committed to that, and in fact, one of the drivers, what we would call the mission of this merger, is affordability. And we have multiple ways of doing it. Choice is an important factor, bringing down the cost of production and passing it back to the student.
Well, we wish you well with the merger, and hopefully it gets regulatory approval at the same time.
Thank you.
Nana Banerjee from McGraw-Hill, Michael Hansen from Cengage Learning.
Thanks for having us.
Thank you for having us.
Sue?
Bill, as we continue on education, today is the deadline for high school seniors to pick their college for next year. But they're not just saying yes to a school, but also to a financial aid package. Students aren't the only ones taking out the loans to cover that cost. Their parents are as well. So we brought back our senior personal finance correspondent, Sharon Epperson. She joins us with more on this. It's great to have you here. I am all ears and I am taking notes. How big of an issue is this, and how much are parents having to borrow to help their kids?
Well, we've talked a lot about the student debt crisis and the fact that $1.5 billion is the amount of money that's owed now in student debt, 45 million borrowers. A lot of those borrowers, though, are parents, not only students. When we look at one of the more popular parent loans, the Federal Parent Plus loan, we have about 3.4 million borrowers of that loan right now, $87 billion that they have borrowed, $87 million, I should say, that they have borrowed. So it's a significant amount. And what's changed is the amount that they're borrowing continues to increase, and they're able to borrow more. So while the federal student loan for undergraduates is about $6,500 in the 27 average loan amount, it was over $16,000 for parents who borrowed. Not as many are borrowing, but the numbers who are borrowing much larger amounts.
So how do these Parents Plus loans differ from what we might think of as the traditional student loan?
Well, the traditional student loan, of course, for the undergraduate, the most important part is the rates are a lot lower. The rates for a student loan, subsidized or unsubsidized, is about 5%. For a Parent Plus loan, it's 7.6%.
Wow.
Add to that the origination fee of nearly 4.25%, and you're talking about a significant amount. A $20,000 loan becomes a loan of more than $22,000 that you then are paying over a long period of time.
You
perhaps.
also dug up some other options that parents have. Tell us about that.
We've talked about this before as well. Don't forget to contact the financial aid office. You've already accepted the offer, but you may want to call and say, let me just appeal this and let you know a few more things about my child, merit-based, need-based, or just maybe the school doesn't have the enrollment numbers, has more money to give you. So that's the first call. The next thing you need to do is look at the federal loans versus the private loans. We talked about the difference in the student loan amount in terms of the rates. Private loans may even get you a lower rate depending on your credit. And the final thing that everyone should do, whether you're a student or a parent, is start paying back that loan while you're in school.
Right.
Because one, you won't have that compounded interest on the debt, but also if you are paying for the student instead of taking out a loan on your own, help your student max out their federal loans and help them pay back those loans so that then they're building their credit, paying off that loan while they're in school.
That is a great nugget of advice.
Yeah.
Sharon, thank you so much. Sharon Epperson.
And coming up, you want to shoot a basketball like an all-star? Guess what? There's an app for that. Okay, all you basketball fans, admit it, if you ever wanted to shoot a ball like a pro, well, now you can with an app. Eric Chemi went to Brooklyn to try it out.
It's game-changing technology that's turning amateur basketball players into the next sharpshooter. Home Court is an app that uses high-tech computer vision and machine learning to improve shooting.
49 degrees.
Available in a free and subscription model, the app tracks shots made and missed, launch angle, leg angle, vertical, and reaction time using just an iPhone. No sensors, no high-tech equipment necessary.
Today, if you run, you're using your Apple Watch or Nike Run app, or you can track all those miles and stuff. But for basketball, that didn't exist. So the first problem we want to solve for is, like, how do we help people easily track their shots without having to do a lot of that manual work?
HomeCourt is a top 10 downloaded sports app in the Apple Store, and it has more than a dozen college and pro teams using it, including Joe Harris of the Brooklyn Nets, who this year led the NBA in three-point shooting and won the three-point shootout.
Okay, I feel good. I did play center on my 6th grade basketball team, so.
Joe and I went head-to-head to test it out.
Oh, I bricked the first one. That's pretty good.
Joe's arc is flatter than my big arcs, and his reaction time is much quicker than mine.
So you're 4 of 20, 20%.
Oh, I didn't even stand in the right spot the whole time, too.
Also notice how consistent Joe's shots are. Every shot's arc tracked the same. Mine were all over the place.
We're in the age of analytics and technology. Anytime you can put that to use just to help you out, improve, get better, I'm all for it.
Joe plans to use HomeCourt at his youth basketball camp this summer. As for me,
a lot of arc there.
I need a lot more practice. HomeCourt is backing from leading NBA minds like Steve Nash, Jeremy Lin, Sam Hinkie, and Mark Cuban. For Nightly Business Reports, I'm Eric Chemi in Brooklyn, New York.
Very cool. Here's a look at the final numbers from Wall Street. The Dow fell 162 points. NASDAQ was down 45. S&P 500 slid 22. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening, everybody. We'll see you tomorrow.